Welcome to Finance Plus Investments, your go-to channel for all things personal finance. Today, we're diving deep into a topic that can put a lot of money back in your pocket, legally reducing your taxable income. We'll be covering a range of strategies, from maximizing retirement contributions to leveraging tax-advantaged accounts. Remember, this is not about cutting corners or doing anything shady. Always consult with a qualified professional before making any financial decisions. With that said, let's get started. All right, let's kick things off with a simple but powerful tool, your W-4 form. This little guide determines how much tax is withheld from your paycheck. Now, most people just fill it out once and forget about it. But here's the thing, life changes. You might get a raise, start a side hustle, or get married. By adjusting your W-4, you can fine-tune your withholdings to match your current financial situation. If you're having too much tax taken out, you can adjust your W-4 to keep more money in your pocket throughout the year. Trust me, getting a refund is nice, but wouldn't you rather have that money working for you all year round? Now let's talk about retirement, specifically your 401k. If your employer offers one, you're leaving money on the table if you're not maxing it out. Contributions to your 401k are made pre-tax, meaning you're lowering your taxable income with every dollar you contribute. Many employers offer an employer match, which is essentially free money that your company contributes to your 401k based on your own contributions. Maximizing your 401k contributions is a no-brainer when it comes to reducing your taxable income and securing your financial future. All right, let's talk about another powerful tool for retirement savings and tax reduction: individual retirement accounts, or IRAs. There are two main types: traditional and Roth, and each has its own unique tax advantages. With a traditional IRA, your contributions may be tax deductible, meaning you could lower your taxable income in the present. The money then grows tax deferred, and you only pay taxes when you withdraw it in retirement. On the other hand, with a Roth IRA, your contributions aren't tax deductible, but your withdrawals in retirement are completely tax-free. So, which one is right for you? It depends on your individual circumstances and whether you think your tax bracket will be higher now or in retirement. If you expect to be in a higher tax bracket later on, a Roth IRA might be the better option. If you're in a lower tax bracket now and want to reduce your current taxable income, a traditional IRA could be the way to go. Now let's talk about education. College costs are skyrocketing, but thankfully there's a tax-advantaged way to save 529 plans. These plans are specifically designed to help you save for education expenses, and they come with some sweet tax benefits. Contributions to a 529 plan grow tax-free, meaning you won't owe any taxes on the earnings as long as the money is used for qualified education expenses. Depending on your state, you might even be eligible for a state tax deduction or credit for your contributions. However, if you withdraw the money for non-qualified expenses, you'll have to pay taxes on the earnings, plus a 10% penalty. If you're planning for your child's or grandchild's education, a 529 plan is a fantastic way to save for their future while also reducing your tax burden. Let's face it, healthcare costs can be a real drag on your finances. But did you know that you can use pre-tax dollars to pay for eligible medical expenses? That's where a flexible spending account, or FSA, comes in. With an FSA, you contribute pre-tax dollars from your paycheck into a special account. You can then use those funds to pay for eligible medical expenses, such as doctor's visits, prescription drugs, and even some over-the-counter medications. The beauty of an FSA is that those contributions are made pre-tax, meaning you're reducing your taxable income and keeping more money in your pocket. However, there's one important thing to keep in mind with FSAs. They typically have a use it or lose it rule. This means that if you don't use up all the money in your FSA by the end of the plan year, you could forfeit those funds. But if you do it right, an FSA can be a great way to save on taxes and manage your healthcare costs. Juggling work and family life can be a real challenge, especially when it comes to childcare or elder care expenses. But here's some good news. A dependent care FSA can help you save on taxes while covering those costs. Similar to a healthcare FSA, a dependent care FSA allows you to contribute pre-tax dollars from your paycheck to pay for eligible dependent care expenses. This can include childcare costs, such as daycare or after-school programs, as well as elder care expenses, like in-home care or adult daycare. By using pre-tax dollars, you're effectively reducing your taxable income and keeping more of your hard-earned money. However, it's important to note that there are limits to how much you can contribute to a dependent care FSA each year. If you're eligible, a dependent care FSA can be a valuable tool for managing those caregiving costs while also reducing your tax burden. Now let's talk about a powerful tool for those with high-deductible health plans, the Health Savings Account, or HSA. This little gem offers a triple tax advantage that can significantly reduce your taxable income and help you save for future healthcare costs. Contributions to an HSA are tax-deductible, meaning you lower your taxable income with every dollar you contribute. The money then grows tax-free, just like a Roth IRA. And when you withdraw the money for qualified medical expenses, those withdrawals are also tax-free. To be eligible for an HSA, you need to be enrolled in a high-deductible health plan. If you're relatively healthy and looking for a way to save on healthcare costs while also reducing your tax burden, an HSA could be an excellent option for you. Now let's talk about a valuable tax credit that can put money back in your pocket, especially if you're a low to moderate income worker, the Earned Income Tax Credit, or EITC. This refundable tax credit is designed to help working individuals and families reduce their tax burden and potentially receive a refund, even if they don't owe any taxes. To be eligible for the EITC, you need to meet certain income requirements and have earned income from employment. The amount of the credit you receive depends on your income, filing status, and the number of qualifying children you have. The EITC can make a significant difference in the lives of working families, providing them with much-needed financial assistance. If you think you might be eligible, be sure to claim this valuable credit when you file your taxes. Now, let's talk about a way to reduce your taxable income while also making a difference in the world: charitable giving. When you donate to qualified charitable organizations, you can often deduct those contributions on your tax return, lowering your taxable income and potentially reducing your tax liability. To claim a charitable deduction, you'll need to itemize your deductions on your tax return. It's important to keep good records of your donations, including receipts and acknowledgement letters from the organizations you support. Charitable giving is a win-win situation. You get to support causes you care about while also potentially reducing your tax burden. Did you know that you can potentially deduct medical expenses on your taxes? It's true. If your eligible medical expenses exceed a certain percentage of your adjusted gross income, AGI, you can itemize those deductions on your tax return. For 2023, you can deduct medical expenses that exceed 7.5% of your AGI. Eligible medical expenses can include a wide range of costs, such as doctor's visits, hospital stays, prescription medications, and even some over-the-counter medications with a prescription. To maximize this deduction, it's crucial to keep thorough records of all your medical expenses throughout the year. While it can be a bit of a hassle to track all of these expenses, the potential tax savings can make it well worth the effort. There you have it, 10 powerful strategies to legally reduce your taxable income. By implementing these strategies, you can keep more of your hard-earned money, invest it wisely, and build a more secure financial future for yourself and your loved ones. As always, it's essential to consult with a qualified financial advisor or tax professional to determine the best strategies for your individual circumstances. Thanks for watching, and don't forget to like, subscribe, and hit that notification bell for more personal finance tips and tricks.